Come on, go.
Ain't no thing.
Come on. Oh, we got it.
Ain't no thing.
Ain't no thing. Come on. All right. Whoever tuned in early to the YouTube live.
They're getting a show.
They're gonna show. They're gonna show. All right, cool. We ready, buddy?
Yes, sir.
You better be ready, because once I start this webinar, there's no turning back, baby. It's like, I just need to set up my screen here just so I can be comfortable. You know where that what that's from? That movie?
Ace Ventura.
Yeah, how'd you know?
I mean, you want me to quote like one of two movies, and they're both named Ace Ventura.
It's true.
And
alrighty then. Welcome everybody to the weekly edition of the Not Your Average Investor Show. We talk about how important cash flow tomorrow is, not just cash flow today, but when is tomorrow? Does it have to be 20 years? Does it have to be 30 years? No. Sometimes it can be as short as 5 years, and you still have to be able to make the best decision for you of when you're actually going to need that cash flow. So today, we are talking about maximizing 5-year cash flow outcomes. I am your host, Pablo Gonzalez. With me here in studio is a man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and his name is Greg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
This is what happens when you make me quote Ace Ventura right before we start.
That lit your fire. We're gonna get back into the Conan hair for you, like where you're really just rocking up there again.
Yeah, I should really just.
No haircuts for you.
I just
see what I did.
It is the gravitational force of your hair that makes me want to do this so bad. All right. That being said, we like to start off with a weekly tradition. You know what that's called, GC?
I do know what that is. It would be ye roll call.
Hey, ye roll call. Kicking off with Joe Bussey today. Say hello, everybody.
All right,
That's
Joe.
Joe, good to have you here. Jeff Pettijohn from Missouri. We got the
Jeff.
early bird in the house from Columbus, Ohio.
Mr. Dean Curry.
Jeff Lendvey in the house.
JWB representing.
JWB represent. We got Le Monsieur.
Reggie Fonse.
Oh, Reggie Fonse from Linda Bay. We got Chris Lee from
Fernandina Beach.
Fernandina Beach. We got Milady.
Jag Chata.
Jag Chata. We got LinkedIn Lowry in the house.
Hey, Lowry, good to see you, my
Lowry
friend.
from Jacksonville. The fairy godmother checking in early today.
Miss Jen Filson.
Jen Filson from the beautiful Monterey, California. Who else we got here? The shaman in the house.
Nadeem Shah.
Suzanne Parker in the
All
house.
right, Susan.
Checking in. Good to have you, Susan. Sorry.
That's right.
That's
I helped you out.
my B. That's my B. The MVP. Everybody's heard of that guy.
Mr. Lee Bishop.
Oh, look at who's back. Leo Faraganan.
Dun dun na na na.
Faraganan.
Dun 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 dun.
Good morning, everybody from Bay Area. It's been a while. Great to see Greg and Pablo. It's great to see you.
It really is
It's
great to see you,
Leo. Leo. Melrose Joanna in the house.
All right,
From
Melrose.
SI, Staten Island, New York. SI.
Ooh.
I was like, Strong Island?
Yeah, I'm glad you got that one. I would have had that
Yeah,
close.
Staten Island. Let's go. Gary Riley in the house. Oh, whoa.
Whoa.
Sorry. Our regulars. From Gary and Rosalind Riley, we regard you. Tell you what.
This guy, rookie
Yeah,
over
man,
here.
I am just screwing it up. Who else we got in here? We got Linda Evans in the house from the Villages, Florida.
All right, Linda.
All right, right down the streets.
It was so great to see him at the summit.
Yeah, we saw Linda.
Leonard.
For now, speaking of another Linda, we saw in the summit, Linda Mercurio.
Oh, that's
in
right.
The house from
Love our
South,
Lindas.
South Carolina. Good to have you. Justine Herrera is back. Good to have you.
All right.
Jeff Moranco, another legend from the summit as well.
Legend in the making.
Larger than I thought. Big dude.
Yeah, you know, it's not often that I'm looking up.
Yeah, he's like a left tackle.
He's an intimidating presence and a teddy bear at the same time.
And it's smart man. All right. And we've got el gran amigo.
Bill Shields.
Muy buenas tardes desde Duval, Bill Shields, to you. All right, let's get into this, GC. We're talking about explaining this concept, and I went down this unnecessarily complicated path of life cycle costs and life cycle analysis. But when I think of buying something, when I'm thinking of buying something that I'm going to own for a handful of years, call it a car, call it a house, call it a renovation project, I found that saying of you pay for what you get rings really, really true when people overestimate first costs versus life cycle costs, right? So if I'm purchasing something and I'm thinking, man, this Honda Civic was only costing me 15 grand, but let's say this hot new electric vehicle might cost me 30 grand, but over 5 years, the Civic cost me, like 75 grand to operate versus the electric vehicle cost me 60, then I'm getting a better deal if that's what I'm going to own it for.
Sure.
So when it comes to investing, I think you can apply a similar lens, right? It's not so much life cycle analysis, but it's like investment cycle analysis. And the idea that as real estate investors, we're not just looking for cash flow today, we're looking for cash flow tomorrow, aka cash flow when we need it, is the closest thing we've come to like explaining life cycle analysis. But today you got a whole new thing for us. Tell us
Well,
about
yeah,
it.
and I think it's so important when we start to think about how to actually analyze the success of a rental property investment. It's like people many times focus on one of two spectrums. Most of the times people focus on here, now, and what that really means is most investors make decisions on cash flow today.
Yeah.
My year one cash flow on that fancy spreadsheet, cash flow today. Another way to look at this, and we talk about this often, we say cash flow tomorrow. So I think in people's minds, what they think is, well, tomorrow might be 30 years from now.
Yeah.
And they say to themselves, well, the cash flows look really great, but we can't think 30 years down the road.
It's hard for humans to do that.
Right?
Yeah.
But what we wanted to do, and what this fine gentleman over here challenged me to do, was to kind of break it down. And it's neither cash flow today, it's not. It certainly is cash flow in 30 years, but it doesn't have to be 30 years down the road where you start to see this benefit. And to show everybody the benefits that you see at the 5-year mark. We chose the 5-year mark. Why did we choose the 5-year mark? Well, it's because 5 years is the minimum that you should be thinking about investing if you are interested in rental property investing. Anything less than that, what are you?
It's basically a flipper.
A flipper, right?
Yeah.
So at 5 years, that's the minimum hold that we ask all of our clients before you become a JWB client. We ask you, are you planning on holding for at least 5 years? So we said, all right, well, let's take the shortest window that is applicable to our community here and our clients here and say, all right, now let's start to think about the investment life cycle, right? The returns on investment from all of our profit centers over that minimum life cycle of 5 years. And I think it's going to surprise and delight many of you.
Yeah, and this is different than IRR, right? Like in IRR, you're talking about a percentage. Here we are saying, what's the cash flow life cycle, right? Like if you're going to look at it in 5 years in a snapshot window, at the end of 5 years, you end up with this much cash or this much cash when you're comparing investments. And, you know, with all this cash flow conversation, what ends up happening is that appreciation, as per usual, plays a bigger role than you expect. And that's when we start really, and appreciation shows up when you're comparing markets, right?
Yes, appreciation definitely should show up if you're doing your due diligence and comparing markets. But I think, again, some people hear the term appreciation, but they don't really believe it helps them.
Yeah.
And even the ones that
They don't appreciate it.
They don't appreciate the appreciation. Thank you.
Yeah.
And even the ones who kind of know the numbers, they say to themselves, well, you know what? That's just appreciation. It's not in my bank account. And that's not really true because appreciation can be converted into your bank account at any time, really. And we're going to walk through how that can happen today. So I want to break that myth that home price appreciation is just something, number one, that you can't count on, because you can, and we can talk about that. But the second myth, which is like, okay, I think I can count on it. I'm going to choose the market like Jacksonville because I can count on it. But they may say, well, that doesn't really equate to my bank account. And so through this case study, what we're going to do today is to show you how it really does. Cash flow, growth, all these things work together. And at the end of the day, when working with a team to help you financially engineer this, we can talk about a lot of cash flow coming into your bank account by being in a growth market that appreciates.
I wanted to talk, like life cycle investment, right? Like investment life cycle. It's based on appreciation, but when you and I were getting ready for this, you're like, yeah, but we got to drive home the idea of market, because generally people are thinking appreciation, but what they're really saying is like, why would I invest in Jacksonville versus Cleveland when I can get $500 a month in cash flow in Cleveland, right? Like, talk to me about how like the idea of comparing market to market is really why we're doing this.
Well, it's what we hear on the sales side all the time. When my sales team is talking with new clients, especially newer investors, they're coming from the school of thought, which is propagated that, listen, cash flow is the only thing, and that's the only thing they look on their spreadsheets. And so they'll say, well, I can get $500 a month on this spreadsheet for this property in Cleveland, day one or month one. In Jacksonville, you're certainly not getting $500 a month of positive cash flow end of story, I should go to Cleveland. And what my sales team really tries to help people understand is, number one, that is not the biggest profit center. There's 5 profit centers. So cash flow, short-term cash flow is actually the least most important part of the decision. And what we also help them see is how much money they're leaving on the table in these other profit centers by not focusing on them, by only focusing on year one or month one cash flow in some of these cash flow markets. So we spend a lot of time doing that. But I think today it's even more than that. It's about looking at the reasons from the lens of like, why would an investor go to a quote unquote cash flow market? Why would you go there versus a market like Jacksonville? And let's put it in the most positive light we can. I mean, at the end of the day, you're going to a market like Cleveland because of the cash flows. If we can just take that and look over a full 5 years, and guys, 5 years is not that long, right? We're not talking 30 years. If we can just look over a full 5 years, how does that cash flow equation really look with a little bit of sprinkled on financial engineering to it? And so that's what we're going to take a look at today.
You want to talk about cash flow? You got it, pal. All right, let's get into it. You see, you put together this. What am I doing here? I don't know. All right, I forgot how to use Zoom. Put together this case study, right? This maximizing 5-year cash flow case study. As you teased it, we are going to talk about Jacksonville versus Cleveland, your favorite market to punch down.
Absolutely. It's going to be the NFL draft coming up. It's about time for me as a diehard Pittsburgh Steelers fan to compare.
It's time. It's time, Cleveland. So that being said, because it's a case study, because we're using real numbers, these are real numbers. They're not guarantees, just a case study. Do your own research. Anything else we need to put in here?
Yeah, we're not financial advisors. This is not financial planning advice, and we're happy you're here, but surround yourself with those that you trust when making a financial decision.
There you go. That's why the team is so important. And speaking of team, if you want a copy of the slides or, you got questions about this, you want to move forward in your real estate investing journey, super easy. There's every way that you want to do it. You can call JWB at 904-677-6777. You can text only 904-293-0341, or you can schedule an appointment. Go to chatwithjwb.com. Joanna will put that in the chat. She already did, and it's going to be in the show notes if you listen to the podcast. So let's get into it. GC, real life case study.
Yeah. So what I wanted to share with all of you is there we go. I guess I'll go to that slide first, huh?
Yeah.
Vanna. Yeah. So this case study, in the minds of a lot of folks, slam dunk. Which market produces more cash flow? You ask, investors in the real estate investing space. Everybody would say Cleveland.
Everybody say Cleveland.
Everyone.
I would say Cleveland.
And I would say Cleveland for day one as well. But again, our lens here is 5 years, the minimum that anybody should be thinking about investing in a rental property. So the question is, which market produces more positive cash flow after 5 years? One of the most renowned markets, the most popular markets for cash flow, which is Cleveland, or our beloved Jacksonville. And the stage is set. Michael Buffer is ready. Ding, ding, ding. Here we go.
All right, here we go. Let's start with, hold on a second. Okay, hold on. Here we go.
There we go.
There we go.
Oh, come on.
Okay, so we're showing Cleveland. We're showing this sexy cash flow market right here. What do we know about Cleveland here, GC?
This is a real property. This is, I'm on all of the lists and checking in with all of our friends and our competitors in the space. And so this is a real property that is being advertised as a turnkey rental property in the Cleveland market. Everything I'm going to share with you is exactly off of that property valuation. The purchase price of $135,000, 2 beds, 1 bath, 783 square feet, so a very small home. It's rented for $1,200 a month. And it produces, according to the property valuation, $5,000 in year one cash flow. Pretty impressive, huh?
It's pretty good. That's somewhere around $420 a month.
There you go.
Something like that.
So
quick math in my head.
And again, if you are in the seat of somebody and you're saying, well, listen, I want year one cash flow. That's the only thing I'm paying attention to. It's a wrong approach, but you might say, hey, listen, this is really, really attractive. And you might say, I'm not even going to consider another market that doesn't get close to this. We can at least understand and appreciate that train of thought.
Got it. So regardless of this idea that Leslie's saying absolutely no curb appeal and it looks like a cartoon shanty town and it's a 2-1 home in Cleveland, hey, $420 a month, you think like an investor, like that's what you're putting your money into. You're banking on these numbers to work out for you, and you take an unemotional decision, right?
One could, if you are going down that train of thought, one could understand why this would be appealing purely from a cash flow perspective. $5,000 in cash flow year one, that's awesome.
Got it. So, in comparison to Jacksonville.
So this is a JWB property. This is one that's currently available here. Purchase price of $226,000. First of all, brand new construction. Over 75% of our homes are brand new construction. So new construction homes are going to be somewhere around $225,000 to $250,000. This one, very representative. So $226,000 for your purchase price. 3 beds, 2.5 baths, a little under 1,300 square feet. Rented as well, and the monthly rent on this one is $1,278. So that year one cash flow is what we preach here at JWB. You want to benefit from all 5 profit centers. You want to be break even or positive cash flow. We want this asset to pay for itself, but it doesn't have to have $400 a month. This is year one cash flow of $65. So really break even cash flow starting out of the gate. So round one in this epic battle here.
Yeah.
We've got Cleveland taking a big lead.
Yeah. Ugly house, 2-1, much cheaper, but way more cash flow. Day one. Beautiful new construction home, much more expensive, bigger, $65 a month in cash flow. It takes $65 in cash flow a year, basically break even.
Yes. And I'm seeing some questions about how did I put these, the numbers and the debt and all that good stuff. I think Jag's asking that question. So I'll go ahead and address that now. When I put this case study together, guys, I used the same apples to apples comparison in every place that I could. So when you start to see how this shakes out, I'm assuming the same percentage down for both the Jacksonville property and the Cleveland property. I'm assuming the same interest rate on the debt. I'm taking the numbers off of the property evaluation from that other turnkey provider.
This is a real property from a turnkey provider that you're using.
Real
their
property.
Estimate.
That's the real picture. That was on the property evaluation.
You didn't take that from like a Bugs Bunny cartoon from the
I didn't. And it's not like I went and found 6 different Cleveland properties to find the worst looking property. That's really what you see when you're buying a $135,000 property in a you're buying renovations.
In a terrible football market. Continue.
I'm gonna have 0 clients from Cleveland after this one. So I want you to know that the one change that I made, because it's based on data, is I looked at what our maintenance and vacancy costs are on our properties for new construction. And of course I used that. And then I used the best guess and the industry norms that I would use for a renovated home, a 2-bedroom, 1 bath, call it 750 square foot, renovated home built in 1950 that looks like that. And so I assumed 15% for your maintenance cost and 10% for your vacancy costs for the Cleveland home. Obviously, Jacksonville's are a lot lower because I have the data on that. And Jacksonville's maintenance costs for a brand new construction home are 4% of the gross rents, and our vacancy is 3%. But I do want you to know, every way, shape, and form, I kept this as apples to apples as I could.
Got it. Are you assuming that no extra repairs need to be done? Ken Potter is asking, what about the repairs that need to be done? Are you assuming that since it's being offered as a turnkey property, that there are no extra repairs outside of that maintenance number that you put in?
There shouldn't be. If it's a turnkey property,
should be ready to go and rented.
Ready to go and rented. Yes, that is what the other evaluation is offering out there, a turnkey experience, which means that there's no additional renovations, even though it kind of looks like it from the picture.
Got it. And then Ken is saying, and then the amount that you put down, you said it's like a 30%, 35%, something like that?
I chose 35% down to make it to make it even for both. You could have put less down in both, but to make it apples to apples comparison, I chose 35%.
Jack has a question about vacancy. How do you get 3% vacancy? Does that include holding costs over vacant period plus repairs?
3% vacancy,
like turn costs and stuff like that.
Well, how do I get 3% vacancy?
Yeah.
We look at the amount of cost that we have relative to the amount of rent that we expect. So you look at what the cost is of the lost rent, and we look at this over our entire portfolio, and you look at what the cost of missing rent, lost rent would be, and then you equate that into a percentage based on what the gross rent would be that you collect.
Got it. So it's rent cost. It's not mortgage cost.
Correct. Yeah.
So
it's
that's actually
lost rent.
higher than mortgage cost.
Correct. Yes.
Okay.
It's the lost rent that you don't receive when your home is vacant. And the way to analyze this over a large portfolio and then to give you the right expectations is to say, okay, well, it's going to be X cost per year over this 5,500 homes that we manage. And then we equate that to what is the gross rental income that's expected. And then that's how you get a percentage basis. That's the way you do it in the industry. And so that cost comes out to 3% for brand new construction homes.
And then turn costs and whatnot, that goes into maintenance. That goes into this, that's in the maintenance bucket, right?
Yeah. So for maintenance costs, the way you get that is you look at all of the actual costs, the maintenance costs that have come.
Including during turns when you're not getting rent.
Including
Okay.
during turn,
So all costs are in.
occupied and non-occupied
Got it.
maintenance, capital expenditures, all of that is included in your maintenance cost. You do the same thing, you equate it. So what is the expected rent that is coming in? And then that's how you get your 4% maintenance expectation.
Got it. Jag, I just wanted to let you know I didn't let him off easy on that one. I made you explain it all.
Yeah. Yeah.
All right. So that being said, so we saw the snapshot year one, right? Is Cleveland is winning in cash flow. Jacksonville's losing by a mile on cash flow.
Yep.
But at the end of the day, the moral of the story here is if we're looking at in 5 years, we're maximizing cash flow in 5 years.
Yep.
This would include a cash out refinance 5 years later, right? So you harvest the equity to take the cash out at the 5-year mark on the clock.
Exactly.
Why do you do that?
Well, number one, and this is what we just taught on last, I believe it was last Thursday or 2 Thursdays ago. So I hope you all joined us for our cash out refinance special webinar. But what I'm trying to share with all of us, all of our clients, even those who aren't clients that own rental properties, that own real estate, is we are sitting on trillions and trillions of dollars of equity. So why do we do a cash out refinance? Because if all you're doing is you're sitting on your equity and you're not doing anything with it, it's like you're trying to get to your financial goals with one hand tied behind your back. You have this resource. Equity is a resource. It's a tool that can be turned into income for you. It can be turned into a return on investment. Because if all you have is equity just sitting there, your return on equity is zero. You have to financially engineer this. You have to work to put that money to work for you so that it can help you get to your financial goals. So with all of our clients, we're working on this with you, right?
Yep.
We're sitting down and we're saying, okay, well, we've got this equity that's now built up. You have financial goals that are more than where you're at today. And we're saying, well, how can we use that equity that has been built up? One of the tools to be able to do that is a cash out refinance. And a 5-year timeline is a very good, very realistic timeline. It can be shorter than that. It can be longer than that. For you, it's actually a little bit shorter because we've had so much home price appreciation.
Correct. For me, like the numbers started getting interesting right around 3.5 years. And I was just kind of like still making that decision as it ages, it gets better and better. Right. So like 5 years is a good like benchmark of, I guess we've never really said this, but it sounds like if I'm an investor in JWB because I'm investing in a growth market like Jacksonville, every 5 years you should really consider this, right?
Well, we should be talking about it a lot, and not just at the 5-year mark. Your JWB team understands how much equity you have in your home. We analyze this for you. We do this on a quarterly basis, and we analyze the market value of your home for you on an annual basis. So we have the data, and our team is reaching out to you whenever we're talking or whenever we're doing a portfolio review, and we're saying, hey, look at this equity that you have here. This is a resource, a tool that can be used to accomplish your financial goals quicker. So yes, at the 5-year mark, that's kind of like a general rule of thumb. That's how we kind of build out these assumptions. But we should be talking about it. If home prices have gone up tremendously at the 3-year mark, that's the kind of the conversation we're having. Some clients might have a combination of homes that are owned free and clear and with debt on them. Well, if there is a goal that is much higher than what it's at today, we might want to have that conversation 2 years after you purchase the homes and say, hey, is this still the goal? This is something that we can do to help you get to your goals faster. A cash out refinance might be there. So it should be an ongoing conversation and something that that's a part of the relationship that we build with clients to make sure that they can be prepared for that.
Yeah, it's why you invest with a team that knows how to do this stuff. It can help explain it to you and give you options and do the research for you and present it to you so you don't have to do all that work. Ken Potter is saying something that I think everybody can echo with, right? This idea that I hear you about the cash out refinance, but with like rates so high, it's hard to consider that. Am I assuming that this is a case by case basis based on like what your goals are, not just like if it's rates this, then you do that. If you have this much equity this, then you do that?
Here's how people get over the rate thing. Rates are higher than what I want right now. I get that. But here's why folks decide to take action and do a cash out refinance and invest in more properties or do something, even though rates are a little bit higher. It's because it shaves off years to accomplish your goals. So you can sit down with my team. We can understand what your goals are. We can run the scenario. We can say, hey, listen, if we were to do a cash out refinance and we were to go ahead and acquire these assets and then we helped you pay down this debt that much quicker, we could shave 11 years off of your timeline to accomplish your financial goal. And so when people see that, they're like, yeah, well, rates are a little bit higher than what I want right now, but I'm in for shaving 11 years off of my timeline.
Yeah.
Right.
Yeah.
So that's how we connect the dots here. And if you weren't a part of the last webinar that we did, just reach out to our team. We're happy to send you a link to it because I actually just showed that exact example of taking your current client's portfolio, doing a cash out refinance, acquiring the right number of homes for that client, and then strategically paying off the debt using a certain strategy that at the end of the day shaved 11 years off of his timeline to accomplish his financial goals. So that's how you get over the interest rate thing.
Got it. There you go. Couple of other questions on variances here. John Bradford is asking, what if you're buying something with a HELOC? Would this still apply? And Game Time Gamison is asking, what about paying in full? I would assume that if you're paying in full, these numbers favor the growth market even more?
Paying.
Like if you're just buying this stuff straight cash, yeah.
Okay, and we're not doing the cash out refinance?
You're not financing the property.
Right off the bat. Well, I mean, yeah, the only reason I'm asking there is because if you're buying it in cash flow is not a question.
Yeah.
Why go to another market if all you need is positive cash flow?
Yeah.
Why are you buying, why are you buying an asset that is going to grow significantly lower based on historical production? Why are you going to Cleveland? Yeah. The population's falling, home prices don't appreciate as much there. There's not, they aren't winning awards for like corporate relocations going to Cleveland. Okay. Yeah. So like the bigger question is if you're buying all cash, it's even more of an easy decision to invest in a growth
because now you also get the cash
flow. Because you also have day one really positive cash flows.
There you go.
You'd make $1,000 a month in positive cash flow in a Jacksonville property, just generally speaking.
Yeah. So what I hear there, outside of you crapping on Cleveland, like to, is that if you're buying in cash flow, in all cash, you're buying that house outright, then Jacksonville is already going to have a year one more positive cash flow because rents are higher.
Yeah. Yeah. Exactly. You had to put more down.
You have to put more down.
So if I was to play the angle of why to do it in Cleveland, you would get a higher cap rate in Cleveland, which means the money that you put out versus the rental income you receive would be, your percentage would be higher in Cleveland. But that's a very small part of this equation. I'm trying to make more money for you all. And so when you look at all 5 profit centers, you would have thousands of dollars of positive cash. You get to benefit from the other profit centers that is in a much higher fashion than you would in a market like Cleveland.
And I think we're going to talk through that better once we get into this case study right here. John Bradford is asking, what if he's buying with a HELOC in a primary position? Can do the same thing without paying interest in the first 20 years and pay it down in 5 to 7 years?
Let me just make sure I'm understanding the question. If you buy a HELOC in your primary position, buy it with a HELOC in your primary position, you can do the same thing without paying just interest in the first 20 years. So I think what he's trying to do is to maximize his cash flow by using debt, if I understand this. Because with a home equity line of credit, you are paying interest only for most of them, and you don't have to make the principal payment, which, in apples to apples, that improves your cash flow. The challenge, John, is that your interest rates on your home equity lines of credit are higher than what a cash out refinance
Mhm.
would do. So I can't run the numbers in my head right now, but I'm not so sure that that would accomplish the goal that you have. And you can start with a home equity line of credit, buy a property. You can then do you can do a cash out refinance and then turn that into fixed debt. So just a lot there, John. What I would recommend is, if that's a question for you, reach out to my team. We're happy to put the numbers together for you and show you, beyond just the theory of this, how it could work for your customized plan.
Yeah, definitely. And same thing with just like, is it possible to buy with a HELOC? This is the whole point of the team. Greg is doing this case study today. People here at JWB, when you get on a call with them, this is what they talk you through, right?
Yeah.
So.
And a HELOC might be the right answer for you too. We did a different training on when home equity lines of credit were a better route for investors. We did that maybe a month or two ago. So if you weren't on that call, you can text the team or give us a call or set up a time to speak with us. Be happy to share the link to that that recording for you as well.
Good news. John is the first guy to bring up Major League movie reference since of all of us crapping on Cleveland.
Oh, yeah.
So I'm going to call him John Wild Thing Bradford from here on out. All right. So here we go.
Major League.
It's the best. I love that movie. All right. So this is the case study, right? So cash out refinance after 5 years. Here's the Cleveland turnkey rental property. Talk me through this, JC.
Absolutely. So in a cash out refinance, we're getting a new loan to replace the previous loan that we have. And this beautiful thing about this asset class that banks love lending on single family rental properties. I've been doing it for decades. So it's not hard to do this. You just go to the bank and you say, hey, listen, bank, my home's appreciated. I've owned it for 5 years. The value of the home was this. Now it's this. And in Cleveland, the way that we estimated what the value would be is we looked and we said, over the last 40 plus years, what's the average appreciation rate for Cleveland? Because markets are cyclical. And there's a good chance that it's going to be somewhere close on average for that home price appreciation 5 years from now, what it was on average for the last 40 years. So in the Cleveland market, as you can see here, the estimated home price appreciation rate is 3.5% per year. So you started with a purchase price of, call it $135,000. That goes up 3.5% per year for 5 years. And the estimated market value in 2030 is now $160,000. There's a win there, okay? Now, what we do is we say, all right, we got to financially engineer this thing. This is the way that I would do it if I was that Cleveland turnkey rental property provider, which I am not, but this is the right way to financially engineer this thing. We'd say, okay, well, at that point in time, we've built up significant equity. Not only have we built up the equity from the home price appreciation, what else has happened during those 5 years, Pablo?
You have also got cash flow in your pocket.
We've got cash flow, but think about what's going on with the resident.
Debt pay down?
Yeah. So for 5 years, we have now a lower loan balance. This is where all 5 of these profit centers come together to deliver cash flow, which we're going to talk about in just a second. So you've got home prices going up in Cleveland, 3.5% a year. Every month, as you've owned this property, your resident is actually paying your loan balance down for you. And so now that loan balance is about $81,000. So we understand what the refinance costs are. I estimated them to be about $2,500. We take this new loan amount out at we take the new loan amount out at 75% of the loan to value. Now we take that amount, we subtract the refinance cost, we subtract our original loan, and that remaining amount is about $37,000 that we could unlock, put into our pockets, tax-free, for us to make another good investment decision, for us to replenish our cash reserves, to make sure that we have peace of mind in this investment, to make to do whatever you wanted to do. So $37,000 with a little bit of financial engineering and doing a cash out refinance is what you could estimate that you could pull out from your Cleveland turnkey property.
Okay. So 37K, if you're maximizing over 5 years, you're looking at this refinance option. That's 37K total. And then in Jacksonville, talk us through this, 48K.
Yeah. So same type of financial engineering, although we're working with different numbers here. So our purchase price started out at $226,000 for this Jacksonville property. But this is really where the difference between home price appreciation rates starts to take shape.
Mhm.
After 5 years, you see significantly more home price appreciation in the Jacksonville market than you do in a slow or a no growth market like Cleveland. And so this is where 3.5% of an asset, $150,000 asset versus 4.8% of appreciation
Got
of
it.
a $226,000 asset really starts to equate to tens of thousands of dollars.
Yeah.
It's like I could talk about this all the time. Like Cleveland's appreciation rate's 3.5%, Jacksonville's 4.8% per year,
Yeah.
but that doesn't really land with anybody.
Yeah.
Because it's hard for us to think about. I'm talking about this 3.5 or 4.8 on an asset that
On a big number.
It's a big
It's
number,
a big number.
right?
Yeah.
So this helps us to see the difference and why it's so important to invest in a growth market. So with all that being said, well, let's go back to that last one there. Just I want to walk through it just a little bit here. So like the market value now in 2030 for your Jacksonville properties jumped all the way up to about $286,000. So we gained about $60,000 of equity, right? We had to put a little bit more in to get it, not a whole bunch more, a little bit more in to get it, but we're gaining $60,000 of equity over a 5-year time frame, right? Now we're going to talk about how do we convert that $60,000 of equity into cash into our pocket or cash into our pocket to make another good investment. And the way that we do that is, of course, the cash out refinance. Although here I chose 65% loan to value. The reason I did this, again, I'm trying to make Cleveland look as good as possible here. And the way to make Cleveland look as good as possible for a 5-year cash flow perspective is, listen, we already know it has positive cash flow day one, a ton of it. So we want to pull out as much capital as we can in that 5-year window to put it back into your pocket. So in Cleveland, because it has so much cash flow, you can pull it out up to 75% of the value and still have it be cash flow positive.
Nice.
In Jacksonville, I chose 65% because if I was to go to 75%, it would be cash flow negative. Not going to do that. So this is actually one way where we are really trying to make Cleveland look as good as possible. In Jacksonville, there's literally money left. There's additional equity in this property that I just didn't pull out, even though I could have done that. I could have,
up the cash flow,
up the cash flow out of this, but I didn't. So even with this super conservative way of going about it, we're able to pull out $48,000. Again, we have converted home price appreciation here into cash flow into our bank account, and this is not creative. This is not doing something unorthodox. Any bank down the street will do this for you. But this is real, and this is the value of a growth market, again, helping you accomplish your cash flow goals.
Yeah, again, not creative, not just not creative, but like being extra conservative on the Jacksonville asset by making it only 65% versus 75%, extra conservative on like the numbers that you're using already to begin with, because you're using performance-based numbers for JWB versus, table numbers for Jacksonville, and you don't know how that's performing based on the property manager, like having their own data, right?
Oh yeah.
So then Cleveland, we are at, actual month-to-month cash flow that you're pocketing year 1 through 5. It's $11,699. Refinancing cash flow at year 5, $36,698. Total cash flow in 5 years for you to do whatever you want, tax-free, $48,397 versus Jacksonville, which has a lower month-to-month cash flow of $2,492, refinancing cash flow of $47,568. Again, like higher appreciation comes into play there, and a total cash flow of $50,060. Pretty good numbers to show, man.
Yeah, I hope this is kind of like an aha moment for a lot of us here, because a lot of us say, oh, well, I'll go to Cleveland, or I'll go to Memphis, or I'll go to Kansas City, or I'll go to these Indianapolis, these slow or no growth markets. And the only reason you're doing that is because you want more cash flow.
Yeah.
But if you're buying and holding, you should be holding on for at least 5 years. So if you look over that 5-year window, you're really not getting more positive cash flow.
Yep.
Especially if you work with somebody who understands how to financially engineer this thing, which is why you work with JWB.
Got it. So at the end of the day, if you're doing it right, you have a professional team that is financial engineers, is giving you the best options out there. Your best option, cash flow wise, in 5 years is Jacksonville over Cleveland. And that's just over 5 years, right? Like that is just under the idea of like, we have a 5 year window for cash flow. I'm 60 at 65. I want to have the most cash in my pocket. And that's what I'm doing. But if you start to expand the time horizon, right? Like this idea of betting on a growth market with a bunch of tailwinds, right? Like it's in like the southeast kind of like quadrant where the weather is good and people are moving to. It's got low cost of living. It's got highest median growing wage rate in Florida. It's the number one corporate relocation site, growing market versus shrinking market that, like people seem to be moving away from. It just kind of, you're like extending more risk the more time you're doing it and you're leaving more money on the table. Is that right?
Absolutely. Absolutely. I mean, I would be curious what else a slow or a no growth market pitches.
Yeah.
One that, and it's not only Cleveland, right? There's a lot of these slow or no growth markets where population is declining, right? Rent growth and home price appreciation growth is way lower. Jobs are leaving, so it's like the one thing that they stand on is we can deliver $400 a month in positive cash flow if we trust their evaluation. But that's really such a short-sighted approach because we can deliver the same net or more positive cash flow after a 5-year window. When you're investing in a growth market, all you got to do is do a cash out refinance. That's all you got to do is do a cash out refinance. And you were right there and you took that. You just overcame that objection for the Jacksonville or for the growth market. You took whatever leg they were standing on as far as the reason to invest in Cleveland. And you probably, they're probably not able to stand on that leg anymore.
Sweep the leg.
Yeah, I didn't want to.
Different 80s movie.
I didn't want to go with sweeping the leg. Thank you. But yeah, it's just it. I just don't see why you invest in a market where population's going down.
Yeah, and I think, if I'm looking at this chart that you've shared with us of Jacksonville home price versus Cleveland since 1981, what's clear to me is that the distance is only getting bigger, right? Like the longer the time horizon, the bigger the difference in the value that you're getting in the Jacksonville market versus the Cleveland market. So it becomes more and more short-sighted the longer time horizon that you have.
Yeah, absolutely. I mean, what I didn't include on the slides, but what I should have done is to show the additional equity that you have in your Jacksonville home when you only refinance it to a small amount versus the equity that you have in your Cleveland home. I mean, the equity is like this beyond what we just talked about. You get more cash flow in 5 years and you have a ton more equity in your Jacksonville home. And the reason for that is because home prices grow. Yeah. And the reason home prices grow more here is everything you just mentioned there. At the end of the day, I just keep it really simple. Home prices are going to go up. Rent prices are going to go up. Median incomes are going to go up in places where population is growing. And because population is growing and people need a roof over their head, that at the end of the day is why Jacksonville home prices have grown 93% more than Cleveland in 1981.
Sounds to me that in a 5-year window, the cash flow argument sweeps the leg, but over a longer time horizon, Jacksonville puts him in the body bag, LaRusso.
I was wondering if we were going to go back. I saw you smiling before.
Yeah, I know. I had that to come by. All right. Anyway, so this has been a great show so far with great movie references. We're gonna get into No Mercy. You're right, Bill Shields.
No Mercy.
All right. I want to get into David Doerr's question. John Bussey's got a question. We got another Not Your Average Guest question. But just to make it all real for people, right? Like this is all based on current JWB inventory. If you're looking at a 5-year time horizon in a cash flow market like Cleveland, Jag, I think she was talking about looking at Baltimore as well. You want to do this type of analysis. Right now, the current JWB inventory is looking like this. It's a minimum around $50K plus investment to get the right financing in order to make it cash flow positive year one. IRRs in the 9 to 10s. Recently, clients are closing with interest rates of 5.4%. That's the value of the JWB network and the different things that you guys can do for clients. And you have these really attractive incentive packages of up to 12 grand.
We've extended the incentives again through April here, up to $12,000 of incentive on each property that you purchase Every property that you purchase, regardless of how many you purchase, every property is going to get between $4,000 to $6,000 in what is called our JWB maintenance credit. That means simply in your first month of ownership on your statement, you receive a check of between $4,000 to $6,000, depending on the property that you choose. And that goes to cover your maintenance costs. Maintenance costs are coming as a part of owning properties. The first $4,000 to $6,000 you can think of being on being paid for by JWB. So that's for every property that you purchase and put under contract through April. And for those who are buying 3 or more at one time, we throw in an additional $4,000 to $6,000 per property. There's no limit to the number of properties you can do this on. I had a friend that I helped purchase 7 properties. So he was able to have, an additional roughly $35,000 for each of those properties. So together, all in all, about $70,000 of incentives for that friend. So if that's you, reach out to our team, whether this is something you can take action on right now, or if it's something that you want to go through this planning process, maybe it's a little bit early for you, want to build up that relationship. So reach out to the team, set up a time to chat with us. There you go. You can go to chatwithjwb.com to set up an appointment. You can text us 904-293-0341 or give us a call the old-fashioned way, 904-677-6777.
All right, GC, let's get into some questions here then to clarify some of this stuff. First question here, David Dorr, really good example. I'm sitting on $750K of equity in 3 homes I own and rent. My monthly cash flow on those 3 homes is approximately $4K per month. Does it make sense to take on debt on these houses and buy houses from you in Jacksonville? I have a call scheduled with JWB next Tuesday.
David, great question. I just love our community, and I love that we get to talk about scenarios like this.
Yeah.
I love that you're also sitting down with our team, because there's so many questions that I would need to ask to be able to give you proper advice in this scenario. My first question is, what's your goal, right? What is your income goal? What is your timeline? If your income goal is higher than what you're earning right now, then you're sitting on a lot of resources here that you're not putting to use. That's that equity. So going back to the beginning of this call, you have great resources. That's $750,000 of equity. Think of that as a tool. Don't fall in love with the fact that it's equity. Think of that as a tool that can be put to use to produce additional income for you today.
Yep.
And can get you closer to your financial goal. You can use that to shave years off of accomplishing your financial goal. But it starts with what your goal is. So the answer to your question may be yes, it may make sense to do a cash out refinance, acquire additional properties. And the justification for that is we're getting there sooner. We're getting to your goals sooner. The answer may be no. You may tell us, listen, I've got this income that's coming in right now. This is going on in my life. I may have some unexpected expenses that are coming down the pike. I might be taking care of a family member or whatnot. And we may say, you know what, David, maybe it doesn't make sense. Maybe your goals, maybe you're just doing a great job.
Yep.
That's possible. At least you'll be able to sit down with us and say, well, you know what, I can look at the numbers here. But it starts with your goals. We'll get an understanding of your resources. Many times, somewhere in the middle is kind of where it lands,
Yeah.
So, but I'm just excited we get to have this conversation. So I'm glad you're chatting with our team. I would encourage anybody who's in a similar situation as David to jump on the phone with our team. We'll actually put some numbers to it and help you come to that conclusion.
A couple of things I like that you explained in David's answer. Number one is you just kind of explained the JWB sales process, right? Like call one is just like what are your goals? Will this thing work for you? Are you sure that this is what you want? If that lines up, then the next call is like, all right, here's how it works financially. Next call is like, all right, let's build a plan for that thing to work financially, right? So I think that's a really good explanation of what you have in store for David, right? So like lean into this idea of like, what are you trying to accomplish? Because that's what the whole first call is going to be. It's not going to be about like, what do I got to do to get you in a house, right? Right. The second thing that I like is like when I was looking at David's numbers, you said this idea that, yeah, man, you could put it all to work or it could be nothing. Sometimes it's in between. I'm just like looking at what he's saying, $750K in equity and $4K per month of cash flow. Man, if you were to take half of that equity, you could basically get 2 houses in, like straight up, right? Like you could almost buy 2 houses in cash off of that equity. Those would like, let's say that you're refinancing half of it. So let's say that drops your cash flow in half, $2,000. Those two houses you're picking up, since you're buying them in cash off of that equity, that is probably going to more than make up the cash flow for it. So it feels like he's got some really good opportunity just to like come out all the way ahead, not just even have to make a sacrifice here.
And this is where financial engineering is so fun and so helpful for folks, because now we could look at David and say, okay, well, David, what's going on in your life, right? If you had to understand what's the minimum amount of cash flow that helps you sleep well at night, that is there for a rainy day fun and make sure that you're able to take care of all this good stuff. What's that number? And if he's, to your point, he's like, well, probably $2,000. Yeah. That's probably what I want. Well, now we can say, okay, well, if we run the numbers, financially engineer this thing, we understand how much equity can we pull out that's just sitting there and still allow him to earn $2,000 a month with his current properties. Yep. And then we can say, okay, well, now we've taken care of the most important thing, which is cash flow needs today, right? We're not going incredibly aggressive here and doing something that might cause some sleepless nights for David, right? We're able to financially engineer this thing, and there is a ton of good that we can do there. So that should be a really fun and exciting conversation.
Cool. Awesome. Joe Bussey has a question. Does this evaluation factor in rent increases for each market?
Yes, absolutely.
There you go. Mike Foster says, earlier you mentioned that cash you take out in a cash out refinance is tax-free. Just want to confirm that that's indeed tax-free?
Yes, it is.
Okay, that was super easy. Okay, now we have from Not Your Average Guest. If you checked in on a text link, I don't know what your name is unless you write it down underneath it. So feel free to identify yourself in the chat. Not Your Average Guest writes, Greg and Pablo, Realtor.com, Miami Herald, Zillow, and some other local websites are stating sharp decline in purchases because of large numbers of egress by median income population, leaving large number of inventory at hand, higher vacancy rate, Jax inclusive among other cities and counties. Cost of owning a home is much higher than lower tax rate that lures a lot of retirees to Florida. Okay, so this is based on like being a retiree. That's not the case with younger working class that's exiting compared to smaller number of millionaires coming in. Citizens Insurance is loading off a lot of its policies because the government-backed insurer has its plate overflowing. What's your view on this?
Well, there's a lot there.
There's a lot.
So let's go through a few of these things, and if I forget, help me out here. So, the first part of the question, and first of all, thanks so much for asking the question. That's awesome. The first part was reading articles about the decline in purchases, specifically in Florida, and this person mentioned how Jacksonville is included in this. You are right. Your timing is almost perfect. I'm not sure if you're on the show. We just did a show, I think 2 weeks ago.
Yep.
Specifically,
Redfin article is saying the same thing.
The exact same thing. So go to our YouTube channel and look up a past episode, and you'll get even more of our views on this. But I read that article, Pablo sent it over to me, and I did a deep dive to understand if that's really happening. And, I'm not sure the source of all the information for the Redfin article or some of these articles that you're talking about. Usually there's one source, there's one article that's written, and then all of these publications just pick it up and regurgitate the same thing. But what we were able to do is actually look at what's happening in the Jacksonville market, and it's not happening. Investor purchases haven't declined. Overall purchases, actually, what we talked about was investor market share in Jacksonville has actually gone up. Investor market share is the number of investor purchases related to the total number of home sales. So I think the number of home sales has gone down year over year, which we would expect. But over the last few years, your investor purchases number is really just like this. It is not noteworthy. It's about the same. And again, I would encourage you to go and see the last or 2 shows ago so you can see the data here.
I just shared it in the chat. I put the episode in there.
Even better. Yeah. So have a field day with that. I'm just not surprised that there are articles out there that lump every, market together in Florida and say, oh, this is happening. I mean, quite honestly, we dug deep into that article and to put it kindly, I just don't think that there was much there to write an article like that. We looked at within the article how it refuted its own statements within the article. So, but that's kind of the narrative that's out there. The narrative is it's a terrible time to buy real estate. The narrative is a terrible time to invest in Florida. And, You know, we've been doing the show for 5 years.
Yep.
I mean, for probably 3 of those years, the narrative has been it's a terrible time to invest in real estate. It's a terrible time to invest in Florida. And all I can tell you is that our clients are doing really, 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 really well.
Yeah.
They continue to have properties that perform really well. Their home values continue to go up every year that we have been doing the show. Rents continue to go up every year. Rents are increasing in Jacksonville year over year. Home prices are increasing in Jacksonville year over year. So it's, you know, there is no statewide real estate market. There's no national real estate market. You need to work with an expert who is in your market, who has access to the data. And, you know, I'm happy to be that expert for you. So,
yeah, I'd also, the next part of it is this idea of like, retirees being the population versus younger people versus millionaires, right? Like that's heavily localized, right? Like if you look at the stats of the Jacksonville market, it has the highest growing median income in Florida. It has the second highest overall median income in Florida. It's the number one relocation city for corporate headquarters in America. And I can just tell you that just like from the anecdotal data, as far as me having lived in Miami and me having lived in Jacksonville, the economic opportunity here versus like cost of living equation is not even close, right? Like you did this whole deep dive in numbers of the purchasing power in Jacksonville being like not a fair comparison to just about anybody else because we're the only big city in Florida with lower than average national median cost of living and higher than average wages. It's amazing.
well played, buddy.
Yeah.
Well played. You were paying attention to that article.
I mean, I've been saying that since I moved here.
I know, but the data,
But the data finally showed it. Yeah. I just felt it.
Yeah.
And then finally, this idea of Citizens Insurance loading off policies. Have you heard anything about Citizens Insurance loading off policy? Like last I heard.
Yeah, that's a good thing.
Yeah.
That's a good thing. We don't want Citizens Insurance to be the insurer for a lot of state of Florida. So this is going according to plan. I'm not an insurance expert.
Yeah.
But Citizens is the insurer of last resort. So a Citizen, those policies getting replaced with private insurance companies picking up those insurance policies is a good thing. There's more insurers that are entering the state. But at the end of the day, guys, here's the thing. When I sell you a property, I need to give you a good estimate for what your insurance costs are going to be that day, that year, and for what's going to happen in the future. And we have the ability to do that today. And a few years ago, we had the ability to do that, but interest rates increased. Insurance rates increased a little, more than we expected. Can't always tell the future. They went up way higher than we expected. Now, guys, the insurance market has stabilized. Insurance premiums are actually starting to come down a little bit. I don't want everybody to get excited because I don't see huge drops coming for your insurance premiums just yet, but that's where it's going. So it is a lot easier for you to make a good decision and understand what your insurance costs are today in the Florida market, in the Jacksonville market, because we are in a period back to stabilization when it comes to insurance rates. So I'm not concerned about insurance. The worst is behind us. And even when I say the worst is behind us, it's important to note those investors, me, I own over 400 rental properties. I felt the pain of the insurance. Here's the reality. At that same time, home prices went up 50% over those years and rents went up 40% over those years. So you won as an investor, even though insurance costs were higher than we all wanted, a few years ago for sure.
Got it. By the way, that was HT. She's saying that Citizens sold my policy to another carrier on my property in Jacksonville.
I'd say that's probably a good thing. Yeah. I mean, that is showing that there's other private insurance companies that are there to insure, which it was tough a few years ago.
Totally.
So that's a good thing.
Totally. And patron Michael Santorios is saying he recently did a reshop of all his policies and every rate lowered.
There you go.
It's pretty awesome, man. I'm actually getting a new roof right now in my house. So I'm expecting a lower insurance rate as well. Pretty excited about it.
Sounds good.
All right, let's do a couple more questions here and get out of here. Ronald Thwing is asking, do your existing properties appreciate better than new builds or the same or the opposite?
We don't have any data to support that new builds or renovated homes would appreciate more. Again, I always tell people I love new construction just like I love existing properties, but after your first year or two of ownership, you know what that you call that property?
Existing property.
Existing.
Yeah.
And you're going to own this for 5 years or 10 years or 20 years or whatnot. So everything is going to be existing, and we don't have any data. It just doesn't, it doesn't really apply because of your length of owning the home, and the appeal of brand new construction is really only there for like a year or 2 or 3 or whatnot. So
Got it. Laura McElroy is asking, if I am at retirement age, do you recommend do cash out refi on 3 older homes with considerable equity and 3 to 4% interest rates and invest in more homes at 6 to 7% interest rates now, or keep those homes with the low interest rates, higher cash flow, especially considering I want these homes to continue paying for themselves and I do not need the cash flow probably for at least 3 to 5 years?
all right, keep that up there. Just want to, always when I get asked a question like this, I want you to have a real in-depth, customized conversation with my team. But let me see if I can pull out some things here just to kind of help for the conversation. So if I'm at retirement age, do you recommend doing a cash out refinance on 3 older homes with considerable equity and 3 to 4% interest rates, and invest homes with the low interest rates and higher cash flow, especially considering I want these homes to continue paying for themselves and do not need the cash flow probably for at least 3 to 5 years? So, what I'm thinking here is, we need to understand what the goals are for you, Laura. That's where it always starts. Because if you come to me and you say, hey, listen, I've already achieved my cash flow goals and I want to have this safety net and I want this amount of income coming in and I've got 3 to 4% interest rates, I'm going to say, Laura, that is amazing. Good job. We don't need to add any more properties to your portfolio. If you come to me, Laura, and you say, listen, I'm at X cash flow today and I want to be 2X that in the next 10 years because I want to do this, this, and this. Well, then that's where we're going to look at that equation and say, does it make sense to actually refinance some of those homes? What is really fun to do is to look at those homes and to say, and to be laser focused and say, well, this home, you can pull out the most equity on this home. Maybe it has a 4% interest rate, somewhere around there, so a higher interest rate. And we can say, well, we can accomplish what we want by just refinancing one of those homes. And we can financially engineer it in a way where we can get the most equity out and the interest rate change is the smallest, right? Because at the end of the day, if you have big goals and you're sitting on a ton of equity, even if your interest rate that you refinance into is higher, it's going to make financial sense. Your years of getting to your goal is going to shorten. You're going to get there faster. We got to get over the fact that your interest rate may be higher. But again, all that starts with understanding what your goal is, your passive monthly income goal, Laura. So please reach out to the team. We would love to have that conversation with you and we can put it on paper. You can look at it and say, well, you know what? If we go down this route, I might be able to shave off 5 years off of my timeline. Well, sure, I'm happy to refinance from a 4% rate to a 5 or 5.4% is what recent clients have closed at. So got to talk to us. Happy to help. I think you got a lot of potential there, and we would love to help you.
It's a great question.
Yep.
All right. So last question. Joe Bussey says, have you done an episode about using retirement accounts to invest in real estate? Yes, we have.
Yes, we have. And we're working on one with our good friend Jason DeBono again coming up. Yeah. So I don't know when we'll do that. Sometime I would say maybe in the next 2 to 3 months, we're going to make sure that we hit that topic again. But until then, just go to our YouTube channel. You go to YouTube and just search for Not Your Average Investor Show?
Not Your Average Investor Show. I can put a link to the YouTube channel here.
Go there. We have all of our past episodes there. You can just do a search once you get there for, retirement account investing or IRAs.
Yeah. Self-directed IRA.
I think we've done a couple of shows on that.
There's at least 3 or 4 shows on that. So, GC, good stuff today, buddy.
Yeah, man. Thanks,
I like this. I did not expect there to be in 5 years a cash flow advantage in Jacksonville versus Cleveland. That to me seemed like a concept for a 10-year, 20-year, 30-year hold. The idea that at 5 years, Jacksonville is already more cash flow positive than Cleveland when you do it the right way makes me wonder why anybody would invest in a non-growing market like Jacksonville.
I just have seen how important it is to choose a growth market. I have seen how important it is for myself, for the 1,700 clients that we choose. And, for a long time, I was pretty quiet and I tried to, be, open to investing in other markets, but I just can't be quiet anymore. Really just investing in a rental property, which you're going to be holding for 5 years, 10 years, 20 years, something along those lines, it just doesn't make sense to invest in a market where rents and home prices don't appreciate. Because when you manage people's money, you see how their money grows in this asset class, the largest contributor to your wealth is home price appreciation.
Home price appreciation.
So you gotta choose a market where people are moving to, where population is growing, where home prices have appreciated more than the national average. It is the most important part of the market conversation, so much more important than short-term cash flow. So I agree with you. I don't want others to make a mistake of investing in a market with slow or no growth, because you are leaving hundreds of thousands, maybe millions of dollars on the table by doing that. So come to a growth market, come to Jacksonville. We're happy to have you.
Good stuff, GC. Next week, we are talking about outperforming a soft rental market and some stats that say we're not in a soft rental market anymore, right? Looks like rents have ticked up, occupancy's ticked up, stuff like that.
Well, I think we are on the doorstep of going and getting out of that soft rental market, I would say. And what we're excited to share with you are the amazing stats that are coming out of JWB's rental homes marketing and leasing and property management teams in terms of people that are interested in renting your homes, the leases that we sign, the leases that we renew. And this is a great leading indicator for you being in a position of strength when it comes to your single family rental property. And so we're excited about where we are as a market today. We are still kind of working through that soft rental market. I'm not ready to officially say we're out of it yet. But guys, the future is bright for being in a position of strength when it comes to owning single family rental properties.
Awesome, buddy. Any last bits? Oh, first of all, great turnout today. Great questions today.
Yeah, this
really
is
good
awesome.
Questions. John Walting Bradford got a nickname today. It's a big day today. Today was the early '90s movie trivia day, which fills my bucket. Started off with the Ace Ventura lines, then went into Major League,
Karate Kid.
then went into Karate Kid.
It's been amazing.
Only the classics. Only the classics. This is really awesome. I applaud you for taking an hour out of your day to show up here, ask great questions, get educated, get a nickname, all the things that are good in this world. And from now till next show, do you see any pieces of advice